How about turning your daily coffee habit into $1 million nest egg? Sounds like a dream. What if I told you a regular person investing just $200 a month into the S&P over the past 30 years could be sitting on a cool $1 million today? That's right, a million with an M. This isn't some get-rich-quick scheme. It's the power of the S&P 500, a proven wealth builder for everyday people. And in this video, we'll crack the code on the S&P 500, reveal the facts, and show you how to tap into this potential, even with spare change. So, without much ado, let's get right in. Building real wealth takes time and a smart strategy, but the stock market, that sometimes intimidating beast, can be your secret weapon. Even if your bank account isn't overflowing, you can still become a serious investor. We're talking about investing a few bucks each month, with the potential to turn those little green bills into a big pile of cash down the line. When you invest just $200 every month like clockwork for a long time, that steady cash stream could snowball into a cool $1 million. Now, becoming a stock market millionaire isn't a guaranteed path, but with the right approach, it's a possibility. So how do you get started on this wealth-building journey? First, you need to choose the right investment strategy. Remember, there's no magic bullet here. Everyone's risk tolerance and financial goals are unique. However, one option that deserves a serious look is the S&P 500. The S&P 500, sometimes called the Standard & Poor's 500, is a market index that tracks the performance of 500 of the largest publicly traded companies in the United States. It is a good indicator of how the overall U.S. stock market is doing. If the S&P 500 goes up, it means the stocks of these major companies are generally performing well. Now let's talk about ETFs. An S&P 500 ETF is a basket filled with the stocks of 500 of America's biggest and brightest companies, household names like Apple, Amazon, and Microsoft. This ETF tracks the S&P 500 index itself, meaning it mirrors the performance of those 500 powerhouses. By investing in just one ETF, you can gain exposure to a diversified pool of these industry leaders, spreading your risk and potentially smoothing out some of the market's bumps. Now imagine you invest in an S&P 500 index fund. That means you're buying a tiny piece of each of those 500 companies. So if Apple's stock soars, the value of your fund goes up too. The same goes for companies like Amazon or Microsoft. Their success contributes to the fund's overall performance. By spreading your investment across hundreds of companies, you're avoiding the risk of putting all your eggs in one basket. If one company stumbles, the others can help balance things out. It's a strategy that prioritizes stability and long-term growth over chasing short-term gains. Now, for all its potential, the stock market can be a bit of a roller coaster. But here's where the S&P 500's muscle shines. While short-term dips are inevitable, the S&P 500 boasts a decades-long track record of bouncing back, even from major crashes. This historical resilience suggests that an S&P 500 ETF is likely to weather future storms, eventually recovering and continuing its upward trajectory. The S&P 500 has a well-earned reputation as a wealth-building machine. Historically, it's delivered an average return of around 10% annually. That doesn't mean you'll see a perfect 10% yearly. The market has its ups and downs. But here's the magic. Over longer periods, those ups and downs tend to even out, averaging closer to that 10% mark. The key to unlocking this potential lies in two powerful allies: time and consistency. The more time your money has to grow in the market, the less you need to invest each month to reach your goals. Let's look at an example to see how this works. Suppose you start investing $200 monthly, and the market gives you a 10% average return in the past. You may amass a tidy $1 million in around 40 years with these parameters. But what if 40 years seems like a very long time from now? Don't despair. By simply increasing your monthly contribution, you can accelerate your journey to $1 million. The beauty of the S&P 500 is its flexibility. You can adjust your investment amount based on your circumstances. Remember, even small, consistent contributions can snowball into a significant sum over time. Let's look at how much you might need to invest each month to reach the coveted millionaire status, assuming that historical 10% average annual return from the S&P 500 holds true. Time becomes your greatest asset here. The longer you stay invested, the lower your monthly contributions can be. For example, if you have a 35-year time horizon, investing just $325 each month could potentially snowball into a cool $1.057 million. That's a testament to the power of compound interest, where your money starts earning returns on the returns it's already generated. The more aggressive you can be with your monthly contributions, the faster you can reach your goal. If you have 30 years to invest, bumping your monthly contribution to $525 could translate to a $1.036 billion nest egg. Even shorter timeframes are possible. With 25 years to invest, a monthly contribution of $875 could see you reach $1.033 million. And for those who can invest a more substantial $1,500 each month for 20 years, a potential $1.031 million awaits. Don't let a late start hold you back. Sure, the earlier you invest, the easier it is to amass a hefty sum. But here's the good news. Even if you're a little behind schedule, building a $1 million portfolio is still within reach. Remember, time is your most valuable asset. But every year counts, even if you can only invest a small amount right now. Over time, those little contributions can snowball into something much bigger, thanks to the magic of compound interest. How many funds do you need to become a millionaire? You might be surprised to learn that you probably only need one. Why? Because they're designed to be very similar in terms of what they hold and how they perform. We can simplify it by having an example. Adding more and more S&P 500 funds is the same as buying multiple baskets filled with the same fruits. Adding more S&P 500 funds wouldn't significantly increase your diversification. Now, there can be some minor variations between S&P 500 index funds. Some might track a specific portion of the S&P 500 index, while others track the entire thing, but these differences are usually negligible. For peace of mind, before you invest, take a quick look at the fund's holdings to ensure it closely mirrors the overall S&P 500 performance. So what should you do? Keep it simple. A single S&P 500 index fund can be a powerful tool for diversification and long-term growth in your portfolio. However, exploring other index funds comes if you want to spread your investment wings beyond the S&P 500. Consider venturing into funds that track different market indexes like the Dow Jones or NASDAQ. These offer exposure to various companies and industry sectors, providing a more comprehensive investment spread. One of the first things to look at is the expense ratio. It is a fancy term for the fees you pay the fund managers for handling your money. Lower is better here. It is more like shopping for a car. You want the best deal, right? So if one fund charges 0.02% and another charges 0.10%, the cheaper one is usually the better deal. Over time, those small percentage points can add up to big bucks. Next up, consider the fund's track record. While past performance isn't a crystal ball for future results, it can give you a sense of how well the fund has been managed. Look for a fund that consistently matches or slightly outperforms the S&P 500. Another thing to chew on is whether the fund is passively or actively managed. Most S&P 500 index funds are passively managed, meaning they simply aim to mirror the index. These are usually cheaper and more reliable. On the flip side, actively managed funds have managers trying to beat the index, but this often comes with higher fees and no guarantee of better performance. Consider where you'll be buying the fund too. If you're using a brokerage account, check to see if the fund is available and if there are any transaction fees. Some brokerages offer commission-free trades on their fund. It's like choosing where to buy groceries. Some stores offer better deals or no checkout fees. Don't forget about dividends. Many S&P 500 companies pay dividends, which are a way of sharing profits with investors. Check if the fund reinvests dividends automatically or if you must do it yourself. Automatic reinvestment can help your investment grow faster, like putting your spare change in a jar and watching it add up over time. Tax efficiency is another piece of the puzzle. Some funds are better at minimizing taxable events, saving you money when tax season rolls around. It is particularly important if you invest through a taxable account rather than a tax-advantaged one like an IRA. It's akin to finding deductions and credits that help you keep more of your hard-earned cash. Finally, it's worth reading up on any additional perks or services the fund offers. Some funds provide access to financial planning tools or advisory services, which can be a nice bonus. Investing in the S&P 500 is a smart way to diversify your portfolio and tap into the growth of the largest companies in the U.S. While you can't invest directly in the S&P 500 itself, you can easily invest in it through index funds or ETFs that track the S&P 500, or by picking individual stocks from the index, although the latter is more labor-intensive. To start, you'll need a brokerage account. Opening a brokerage account is straightforward and can be done online with various brokers like Vanguard, Fidelity, or Schwab. These platforms often have user-friendly interfaces, making it easy for beginners to navigate. Once your account is set up, you have a couple of routes you can take: S&P 500 index funds or ETFs. It is the simplest and most popular way to invest in the S&P 500. An index fund or ETF that tracks the S&P 500 aims to mirror the index's performance by holding the same stocks in the same proportions. The main advantage here is diversification. You're spreading your investment across 500 companies, reducing the risk of investing in single stocks. Additionally, these funds typically have low fees because they are passively managed. You choose the fund, invest your money, and let it grow over time. Alternatively, you can buy individual stocks if you prefer a more hands-on approach and have the time and knowledge to research each company. This method can be more rewarding, but also riskier and more time-consuming. You must monitor each stock's performance, stay updated on company news, and make buy-sell decisions based on your research. For most people, investing in an S&P 500 index fund or ETF is the way to go. Look for a fund with a low expense ratio, the fee you pay the fund managers. Vanguard's VOO, Fidelity's FXAIX, and Schwab's SWPPX are popular options. They all track the S&P 500 closely and have low fees. Transfer money into your brokerage account. You can start with a lump sum or set up automatic transfers to invest regularly. Once your money is in the account, search for the ticker symbol of your chosen fund, example, VOO for Vanguard's S&P 500 ETF, and purchase shares. With some brokers, you can buy a whole share or a fraction of a share if you start with a smaller amount of money. While one of the perks of index funds is that they don't require constant monitoring, it's still good practice to check in occasionally. Ensure the fund continues to meet your investment goals and make adjustments as necessary. Investing is a long-term game. The S&P 500 has historically delivered solid returns, so patience and consistency are key. With regular investments and a bit of patience, you'll likely see your money grow. With that said, let's wrap it up. Stay tuned and subscribe for more amazing videos.